welcome to Market Buzz. I'm Greg Schnell, the founder of Osprey Strategic and host of the Market Buzz. Each show we do a deep dive into different industries using weekly charts to see what is happening on a long timeline. Please follow me on Twitter at Schnell Investor, and you can also find my blogs on ospreystrategic.org as well as StockCharts.com. So the main problem with the bull market is it's uphill all the way, and we're finding that out right now. So I want to talk a little bit about gold today. I'm going to go over the markets to begin with and talk about the broad markets, the commodity markets, and they're really choppy. And then perhaps why this might be setting up for a period to look at gold. Okay, let's jump into the charts. And what I want to start with here is the S&P 500, and you can just see on this chart SPY on the left and QQQ on the right. And what we see here is the market's been pulling back, and over the last week we haven't really gone down or up. We had a brief dip down on early last week and are now trying to push higher. So one of the things that's starting to come into play is, this is a long period PPO, but it's coming into play that this might actually cross up and get going here. So that would obviously be good news. And then when we look at the daily chart, what we see is we're trying to hold this 50-day moving average, and on the NASDAQ trying to hold the 200-day moving average. So the charts are in a mixed place and they really don't have direction here. I'm open to either a move higher or a move lower. I'm just waiting for that to happen. And one of the important things to note about February was we literally pulled back all month, and there was a lot of mixed messaging this month, and I want to try and identify how I work through that and see if it can help you at all. But the idea behind, looking at this market, buy and hold investors are down a few percent, and the people who are swing trading are probably up or down a few percent. But the main message that we have to watch for here is, do we have a plan for if the market does unravel, and do we have a plan to get back in if the market goes higher, and how do we stay on board while the market's working? So I'm going to cover that off in just a little bit here, and then get into the commodities charts and go through there. So first of all, one of my main tools here is my Schnell strength indexes. And what I did was I tried to create an index that's going to fire off and show me when the market's starting to get weak. Now, the problem we've had with the stock market here is we've had rallies, they've been brief or they've been long, and we really don't have anything good to help us through that. One of the problems with the most recent pullback is the market had kind of decided inflation had gone away, and then all of a sudden inflation, the data has continually come out saying inflation's stronger than we think. So what we're really looking for here is the crossroads of, can the market get past this, or do we start our next leg down? And so the way my indicator works is I try to I have a group of market analysis charts, and I try to just keep track of whether or not most of those charts are improving or not. And one of the things that happened back in November last year, we had a relatively straight up, and then we had this very slow, deliberate decline. And it was literally as the market was changing its mind from bull market to bear market, and really didn't know which way to go. And then again, we had a rally in December, and it was choppy, and then it obviously rolled over, and then we rolled down hard. One of the things that makes trading so difficult is, if you do get out of the market, when do you get back in? And if you're out of the market, how do you stay out of the market to avoid the downturns? It is hard work for everybody. There is no question. The one thing that I would say is, if you're trying to trade the market, at least the one thing we would have had here, I like for the market to get oversold into a low level on my indicator, and then it bounces higher. And you can see I put a PPO for my strength indexes down at the bottom here. And really a pretty good clue when this started to roll over, at least start to be cautious. And then as this actually went negative, that was an even better clue that we were about to top out here. So the market has been giving us some clues that we're breaking down. And one of the things that we're going to struggle with here, let's just say we get a rally into March. Cool. So as March starts to rally, then what are we going to look for to help us if the market is going to roll over again and start to break down? What are your clues? And the biggest problem I had as an investor was trying to stay out of the market when it was poor and how to get back in the market on a timely basis on the way up. So one of the reasons I came up with these strength indexes was to help me with that. So currently they're negative, they're all in the bottom, but what I like to call that is they're in the buy zone. And so it doesn't mean to start buying yet, but it definitely means if they're going to turn up, this is where you'd want to watch. And what we saw in September of last year was a brief 4-day bounce, and then the market just continually sold off. So there's signals like that are going to make it hard, but at least you had some sort of a signal that was firing off to go with, and then if it didn't work out, you had a reason to exit. Now, as the stock market continues to evolve here, some of the people are trying to trade through it, and what I find is it's just very difficult. Last week, over 800 stocks were down more than 10%, even though the index was only down 2%. So a very difficult trading environment, and we're starting to see, even within materials as an example, there were probably equal as many up as down. Market very choppy, very difficult, no real trending, and yet we're trying to trade through it. So one of the ideas that I had was, once the market is truly out of favor and starts to turn up, then at least I have a place to look for entry. And so we're there now. So that's the good news. Looking for an entry, and maybe I don't get it for a month. Maybe I get it for 3 days from now. Maybe it's March 1st today. So as it goes forward, what I want to watch for is this indicator to start turning back up. But I am still worried about the overall backdrop. So I need to make money while the market is rising, and I just want to avoid the pain. So at the beginning of February, I'm cautious. I'm out of the market, and I'm looking at a lot of my fellow technicians, and they're all bullish, and they're still bullish. And what happens is you actually start to doubt your own work, because you're wondering, okay, my charts are changing. Why aren't they seeing it? And so I think it's one of the strengths that I like about the strength index. If nothing else, it makes me double check my work, triple check my work. But keeping on the right side of the trade, and there's so many different methods. So there's two different specific ETFs, and one of them is the IBD 50. Let's just clear this off. The IBD 50 Innovator Fund, right? So 50. And then we're going to put right beside it the FV, which is the Dorsey Wright model for relative strength. And what I found pretty interesting is the Innovator 50 fund last year basically had a scooter ranking in the bottom 10% for the whole year. So if you bought the best IBD 50 stocks, it was one of the worst performing ETFs all year. And the Dorsey Wright model focuses on relative strength, which is fine. One of the things that it was heavily involved with last year was energy. And so it held up pretty well. It did pretty well. And what the scooter ranking tells you is how it's comparing to its peers. So we're sitting here where the IBD 50 model is clearly a difficult way to own stocks in this trading environment. Then we have the Dorsey Wright relative strength only, and it's working okay, right? You're up near the high still, so it hasn't really lost money. I would just say, you've been in the market since, let's say, November, and have you made any money? Well, no, it's kind of been choppy. So that's the main point, is just hard to make money in a choppy market, even with some of the better indicators. So what you'll see from the IBD 50, and I think this is a pretty important clue here, the scooter ranking is a lot more choppy and essentially performs on average in line with the S&P 500, and that can be seen in this purple area here. And then over here, the Dorsey Wright was actually underperforming all of 2019, marginally outperformed in 2020, and then in 2021 underperformed because it was pretty much sideways. And then what we saw in 2022 was it stayed sideways, so it actually outperformed very, very well. But looking at these two, I'll call it growth investment models, you can see that, we've all been led down this road of how to trade the market, and, this system works and it works all the time and whatever. I think the real difficulty here is even some of the best ideas or fund managed ideas aren't really working. And of course, we can go to the ARK funds, and let's just look at this scooter ranking, right? They've been horrible, starting to perk up right here. And so perhaps either we're buying junk or there is a rotation back into the stocks that I'll call it the innovation stocks. So we want to be open to that idea. Perhaps this is just a bull flag and we're going to take off from here. Or we also need to be aware this, really this fund hasn't performed since 2020. And when you look back at these funds, 98% of the people who invested in them have lost money. And the reason is because a lot of them put money in late, right, after the big move. And then what happened really since all the volume came in, the indexes have lost money, or the ETFs have lost money. So there's a whole bunch of multiple models out there. And I think the hardest part for me is to have any confidence that whatever relative strength or buy and hold or innovation or, autonomous technology and robotics funds on the right here, or the genomics funds, or the, all of these different models could be the artificial intelligence ETF, right? All of these things have their time when they work, and when they don't, it's really hard to make money. So what I try to do, again, is to use this SSIF, even if it's on a short-term basis, to get in when the market's starting to turn up. I want to ride it. In this case, it was, 4 or 5 weeks. And then in this case, it was relatively short, actually. It popped up in early January, and it already started to drift off right away in mid-January. So I was getting more and more cautious, and everybody else is more and more bullish. And I'm, my charts are showing the strength of the market move weakening. And so you'll see this change. Anyway, the idea is you're roughly going to get 5-6 buy points a year, and you try to make money during those 6 up thrusts, and then especially if we're in a choppy market, and then just try to avoid the down. And still hard work, but at least you've got kind of 6 opportunities that you're putting money to work for a reason. And if you're wrong, you can get out quickly rather than buying near the highs after the market's pushed up for 6 weeks and waiting again. So those are just some of the clues of the way I'm trying to trade the market. And I think, again, even if you go to the best funds, or if you go to Joe Terranova and Katie Stockton, right? Joe T. and Katie Stockton, they're on TV and they're quite popular, but I would just say their funds haven't really done anything relative to the S&P 500. They're performing pretty much in line. Joe Terranova's ETF is doing a little bit better. Scooter ranking has been holding up at least in the top half. So that's been a little more powerful. And then these funds have both just launched. Joe Terranova was an excellent commodities trader and broadened out into the broader economy. And Katie Stockton is a technical manager and uses, her approach, and I think a lot of it is based on Tom DeMark's work, to manage her fund. So regardless of the type of work you do, these guys are all finding it a very difficult market. And my main goal here is to make money when it's easier and get out when it's not. And so sitting in cash can be difficult because you start to see the market turn up for a couple of days and you get interested. But we really haven't seen a sustained thrust. So for me, I'm going to be sitting on the sidelines and waiting. Now, here's an example of a tool you could use just to trade something like gold. And so what I've done is I put silver up here, gold and silver, the precious metals, the bullish percent index for the gold miners, the silver index, the price of silver, and then the ratio of silver and the miners together. So I think I said that all backwards. Try it one more time. Here's silver, and SIL is the silver miners, and then this is the bullish percent index based on the point and figure charts, and then you have the ratio. And so the ratio has actually just started to turn higher here, and so it's one of the reasons I want to start watching the stock. What we should start to see, though, is if this is going to kick up, then something needs to, obviously be reverting higher. So that's what I'm watching for as this goes forward. And in this particular case, they've had a steep pullback. So if we just go look at gold and gold miners here is the chart for GDX. It's just been straight down, and gold has been straight down as well. So all of a sudden, this is starting to flicker above this downtrending period on the 60-minute chart. We've got our PPO cross here to start, and it's just starting to ring the bell. This is midday on Tuesday. And the chart's trying to bounce off the 200-day moving average. So if there was something to look for, at least I've got some reason to kind of go there. I'm starting to get, and again, this isn't a 12, 26, and 9 PPO. It's different. But we're starting to get buy signals on this chart. We're bouncing off the 200-day for the gold miners, and the actual price of gold is held up a little bit better, and it's trying to thrust higher. Now it's only up 0.72%. Let's not get too crazy about how awesome this bump was on a Tuesday morning. But the idea of seeing these charts in big downtrends, if there was a place to look, you want to try and find it near support, and if support isn't going to hold up, then we'd like to just exit. Now I want to go and grab, I'm just going to grab $ gold. And the reason I want to do this is I want to go back to a specific period of time. And I'm going to go pick 2001 and take it to 2003. And there's a specific reason that I want to talk about this period. What we see on this particular chart is the chart kind of thrust up, pulled back, thrust up, pulled back, and it started to find support around its 200-day moving average while the overall stock market was going the other way. So if we put the price of the S&P 500 behind the price on here, we're going to make it a solid thick line, and we're just going to go with blue. And then what we can see here is pretty much, it wasn't a good correlation like on an hourly basis or a daily basis or whatever, but the general trend was gold ended up going up while the overall economy was pulling down. And so it's this change in direction that I'm looking for. And one of the reasons I'm thinking about it now, first of all, one of the big moves happened at the end of February back in 2002. This is also where, the beginning of February. This is also where the kind of the final high was in the S&P 500 before it rolled down on another big leg lower back in that period. So we're right in that period where we want to watch and see, and gold recently, let's just go here, gold recently had a big thrust up and a pullback. And so now if I look at this here, is this our big thrust up? We've pulled back and now we're about to take off on the next leg of the run. I really don't know, but if I was looking for something similar, if you've looked at any of the articles I've written, I've showed a very good comparison about how the the momentum in the market is set up relatively similar to February, March of 2001 2002, how it rolled over right in this period and then obviously got weaker for a while. So if we're sitting at that moment, perhaps this is the moment where we start to see a new uptrend establish in gold and move higher. Okay, so we've got that as an example. Now, you know, it's very choppy here looking at, this is the gold miners, this is the price of gold. If we take this same chart over here and just expand it back to 1998, what you'll see is that gold had an awful time in 1999, and then I can't even remember what caused this ballistic move, but then you pulled back for a few years before you started to take off to the upside. So just think about this kind of 2-year period from the market top or near the top in 2000, and let's go back to this chart. And what we see is we had this run up, and then basically it's been declining. And now what we're looking for is, can this decline, now that it's back above the 40-week moving average, can we start to turn up here on either the gold or gold miners, or are we just going to suffer? And I just think that money's going to try and go somewhere. So I'm looking at this 2-year pullback in here and just saying, you know, perhaps we're climbing out of this hole and now we're on our way. So again, going back to this chart, you know, we've had a kind of a 2-year pullback. We've started to climb up, and we've tried once before, pull back second time. And now, you know, to me, this would be your final low. This low on the PPO down here, I think on the monthly chart, it was for gold. Let me just go get it, update, and then I'm just going to shift to a longer period. So over a 30-year period, what you saw was well, this is GLD. Let's use $gold. And what you saw here was we actually got the PPO momentum way down low. We came up, and then on this monthly chart, we're starting to rally right around the 0 level. Typically, to me, that's a really nice place to enter. So I'm thinking this is, you know, similar to 2019. We bounce off this level, and if we're wrong, we're out relatively quick, and we can just say, no, it's not the time. But the point I want to make is that gold started to make its big run while the overall stock market was still going down in here. And it's that kind of clue that perhaps this is the point in time when we actually switch and we go from stock market to investing in gold and just see if there's anything there. Now, we don't have a scooter ranking for GOLD because it's not a tradable ticker symbol. But if we switch it out to GLD, and it's only going to give us half the chart, but what you see here is GLD kind of pinned itself up against the highs a lot back in those days for that big commodity run. And then StockCharts came up with it in 2007. But then what you saw in the 2012 period to 2015, this scooter ranking pretty much stayed near the bottom. Now it looks to me like it's staying up near the highs again. So it's one of the reasons I want to start to look at it. And again, we've got a whole bunch of debt issues going on around the world. So I'd like to see this big trend on the monthly PPO break. And if that happens, that would be very bullish. Now let's just switch this over to weekly. And what you can see on this chart here is this is kind of the bounce we got on gold here came all the way down. We pull up, and now what you'd like to do is make a higher low, much like this 2018, 2019, and bounce out of here and see if we can do that. So I'm on watch for gold to see if it can start to fire up. Again, just lining up a whole bunch of different dots, but the chart I put out before comparing the 2002 period to the 2023 period, they match up quite nicely. And then we also have the issue where where we still have a rising interest rate, which is hard on technology, which if technology stocks were to continue the road south, then, investors are going to try and look elsewhere, and perhaps that changes over into gold. Now, the last thing that we can look at to judge that is IGV, the ratio. And what should happen here, let's just shrink this back down. Let's go to whatever, 10 years or 15 years. What you can see here is this ratio is now broken, where gold underperformed the software industry for a long time, and now we're sitting pretty much flat. And so we're trying to decide which way this is going to go. For me, I still think it's worth watching. In an overall downtrend, I think it's always hard to trade. I'm going to stick with my SSIF, and if I start to get any kind of heartbeat in this gold trade, then I would probably start to put that on. So with that, thanks for taking the time to join me on Market Buzz. Market Buzz airs Wednesday at 10:30 a.m. Eastern, and you can also see the recording on StockCharts TV YouTube page. Thanks, everybody. I'll be doing a special presentation on March 15th to try and explain again how we use the Osprey strategic system that I founded to try and help us find market lows that are more investable. And if you thought that January low was a pretty good one, I didn't trade it very well, but all of our data kicked in right at the right time, and it took off to the upside. So with that, hopefully there's something there for you. Head over to the website and you can check it out and just see if there's anything you'd like. Pricing is found on the homepage. Thanks, everybody. Bye-bye.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.